Good afternoon. My name's Lee. I'm the Australian Shareholders Association Chief Marketing and Education Officer, and we are here today with Andrew Page and Pete Wargent for round two of the Great Aussie Debate, a little bit of a tongue-in-cheek topic where we're discussing, not arguing, property versus shares. What kind of investment suits you? And of course, that is a very individual question, and nothing that we're going to say today is advice. It's all for information, education, and a little bit of entertainment. If you have questions, you can use the Q&A or the chat area in your control panel. For some of you, this might be the first time using Zoom, as the ASA has always been on GoTo, but it's very easy. You can just go down, hit the button, type in your question, and we will have a Q&A section at the end of the conversation. We'll also obviously try to get to as many questions as possible, but if you have more we don't address, feel free to email myself and we can connect you with the guys or have this conversation again. All right, without further ado, I want to hand it over to Andrew and Pete. Thanks for joining us again, guys. This is great fun and should be enlightening for all.
Yeah, thanks Lee.
Andrew, we meet again. Good to get back on and have another debate with you. I know we've done this once before, but loads of new people attending today. So I think what we did last time, you gave us your best arguments for shares, and then I came back with a retort for the property side of the debate. I think we were chatting just before we came on. We might not change too many minds today, but we'll do our best. And as Lee said, it's all in good spirit and good-natured debate. So, yeah, I guess we were just saying before we started, it's been an interesting year for property. Interest rates up very sharply. Nobody was predicting a year where property prices would go up in that environment. And yet over the year, about 9%, I guess, across the capital cities. Sydney and Perth have done more than that. Some of the other cities a bit less. So yeah, big surprises there. I guess it goes to show you can take some of the predictions with a grain of salt. But Andrew, do you want to kick us off then and give us your base case or your best arguments for the equity side of the debate, and then I'll come back on my side as well.
Yeah. Thanks, Pete, and hi everyone. So yeah, I'll just reiterate, this is all in good fun, and I think all of us in Australia, you have a very firm view one way or the other with this kind of stuff. So whatever camp you rest in, you will find some confirmation bias here today. I did also want to stress here too a couple of points which I always think are important, is that it's not either or necessarily. You can do both, and you can do whatever is right for you. And I also, right at the beginning, as I did last time, really want to tease apart the difference between owning a home to live in, i.e. for its utility, versus an investment. And you can't live in an investment portfolio of shares. So I want to very deliberately focus on the investment angle here, because otherwise it's a chalk and cheese kind of thing. So from the investment angle, what's the high level view? I think the first point, I guess, is a historical one. Shares have typically in all developed markets outperformed property over the long run. There's periods where that's not always true, but generally it tends to be true. So that's nice. It's also nice too, and they're very, very liquid assets. The cost of that liquidity is volatility, which makes sense. If you held an auction at your house every weekend, you watch how volatile that asset becomes. It becomes extraordinarily volatile. So the lack of volatility in your house is a reflection of the poor liquidity. So how do you want to frame that up is depending on what you see as most important. But I would argue liquidity is an advantage for those that do have the fortitude for it. One, it provides opportunity, but two, it means that I can get into a equity investment for as little as $500. And I might have a $10 million portfolio, but if I want 10 grand for something, I can sell 10 grand worth of shares. I can't sell the garage, or I can't sell the bathroom of my investment property. It's all or nothing. And then it'll take 6 weeks to settle and a huge amount of fees. So that liquidity thing for me is a big plus. I think the diversity angle is a big plus for me, just sticking to the high level points. Yes, they're all shares, but you can invest in anything from a REIT to an ETF to a small industrial company to a tech company, you name it, right? So you can walk all over the place, and with a very modest sum of money, have a very great deal of diversification. So yeah, good returns, very liquid, very easy to diversify. It's probably where I would start.
Yeah, good point. So yeah, I guess interesting on the returns point, because I guess with real estate, there's been some studies in the US, like Schiller, for example, did some studies and showed that over the very long term, residential real estate has only really outperformed inflation by a small amount. Now, I guess in Australia, we've been a bit conditioned, being a very, very urbanized economy, to land prices going up faster than the rate of inflation. So I guess if you went back to just before you and I were born in 1970, a house in Sydney, just a median house, would cost you about $18,900. Today, whisper it quietly, but I guess you're looking around about 1.4 million just for a median house price. So that's about 8.5% nominal returns compounded. Melbourne's gone from about $13,000 to 1 million over the same time horizon. Again, about 8.5% or 8% compounded. Those are nominal returns. You're absolutely right, though. That does feed into your point. It's pretty difficult to have a small portfolio of property in those kind of markets. Now, obviously, there's more cities around Australia, particularly regional markets, that are cheaper. Yeah, the liquidity point is a real downside, I guess, for property. I guess the reason that most people get into property, now you mentioned there, you can go here, there, and everywhere in stocks and shares. You can. I guess the potential danger there is, I remember reading some of these books years ago about investment clubs, and people were putting in $25 here and $50 there. They were learning all about stocks and shares, which is fantastic. There was a couple of women's groups in Sydney. I remember going to some of the seminars. But I guess the danger there is that if you're just tinkering around at the edges with small investments, you're not moving the needle. Now, Australia's done one thing really well as compared to a lot of European countries, and that is compulsory superannuation. And that really does force people to get into investing for their retirement. So look, I guess the one reason that people do go for property, particularly residential, as an investment is just the leverage point. The ability to invest with more dollars, so some of your own as a deposit and the bank's leverage. Now, I was quite interested to read, actually quite topical, Charlie Munger's last interview with CNBC with Becky Quick. And, I guess we've all heard the Buffett quotes about, leverage is, if you're smart, you shouldn't need it. And if you're dumb, you definitely shouldn't use it. Take a drink for nominating the Buffett quote. But surprisingly, he said that if they didn't have external shareholders, they would have used leverage to create more wealth sooner. And it's something that, even at the age of 99, he does think about a little bit. So that was a real surprise to me, because you never really hear the guys at Berkshire saying that kind of thing. And I guess that is the point, really, is that by using some leverage earlier in the journey, you can let inflation sort of inflate away the debt over time. Obviously, there's some caveats here. Charlie Munger said in that very interview, you should avoid crazy at all costs. And I think, sometimes people can take a good idea and take it to a stupid extreme, as I'm sure you're going to point out. But yeah, I guess there's very, very few sure bets in finance. I think, but there's one bet that I'm pretty comfortable on taking, and that's on inflation. I think there is upside risk to inflation, as some countries are finding out, like Argentina or Turkey. But these days, there's very little risk of deflation. Not now. I think governments and central banks in developed countries, they would literally drop money out of helicopters before allowing that to happen. So if you take out a 500K loan today, in 30 years' time, it's going to feel more like about $200,000 equivalent because of the inflation over that time. We've got a 2.5% inflation target in Australia. So I'm not a walking compound interest calculator, but in my head, that's under 250K anyway. So I guess having some exposure and some leverage at a relatively early stage in the journey, if you've got a long runway, well, of course, that's why real estate is popular. It's why relatively, I was going to say dumb people, that's probably not the right phrase, that's Mungerism, but people who aren't that smart have achieved pretty good things in property just simply by buying and holding for the long term, allowing inflation to do what it does, and adding some value where they can. So does that make sense?
Yep, it does, and it's something that is worth really stressing here too. Is that there's two parts to any investment. There's the asset that you're buying. There's the quality dimension. What, Peter Lynch is famous for saying, know what you own and why you own it. And so when you look at the asset that is residential property, it's a good asset. Well, the building's not much of an asset. The land's a really good asset, right? They're not making more of it, as the saying goes, and you can use leverage, and it's brilliant, right? I don't think any right-thinking person could have anything negative to say about it. My negativity at present comes from the second dimension, which is price. And this holds true for shares too. In 2007, in 1999, pick the top of whatever bubble you want. Were equities, were these bad assets? These were BHP, these were Woolworths, this was Cochlear, this was CSL. These were very, very profitable, robust, safe companies. But the prices didn't really make sense. And therefore you can, speaking of Buffett and Munger, you can do really badly in a very high quality asset if you overpay. And you can think about it rationally. Your house for $1 is the bargain of the century. For $10 billion, it's the dumbest investment you could make. Now, the asset is the asset. So it's worth teasing that apart. And I really want to stress that I love the idea of property and land. I think it's great. Where I have a bit of hesitation at present is that, and we touched on this last time, Pete, so choose your metric, price to income, debt to income, gross yields, you name it. And we're world champions, right? We're way up there. Hong Kong has got nothing on us, right? And we've got a lot more land than Hong Kong. And you got a situation now where the cost of capital is the highest it's been for a long time. And I agree. I don't think inflation's going away, but I don't think we're getting back to these very, 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 very low interest rates. We had this structural decline for 40 odd years, which was a phenomenal tailwind for equities and property. But
I don't think anybody should be hoping for zero interest rates. I don't think it's a healthy place to be. I think let's not veer off into cryptocurrencies and everything else, but I think zero interest rates come with their own problems. They used to say people would build bridges to nowhere in the zero interest rate environment. And all right, we didn't necessarily do that, but we did some pretty crazy things as an economy. Interesting.
Complete misallocation of capital, Pete. Like it was the amount, when money is free, a lot of dumb projects that otherwise wouldn't make sense make sense. But as we know, those things tend to normalize. And when you're going into something, an extraordinary degree of leverage under the, with a 20 to 30 year commitment with your debt, under the assumption that over that entire multi-decade period that interest rates are never going to go up, I think it's a bold assumption.
Yeah, I think you're right. I think residential rental yields tend to be low anyway. I think the rental yields will actually come up over the next little period, partly as a function of lower prices and partly as a function of rising rents, which we're definitely seeing at the moment. It's not a very attractive environment for a lot of investors. A lot of people are selling down, particularly in Victoria. So the rental market's very, very, very tight at the moment. I think on the price to income point, I mean, this is actually a part of Australia's challenge. Australia's housing market has partly been successful because Australia's been so successful. Now I come from, obviously, as you can hear, the United Kingdom, very much a boom-bust economy. We've had these big debt booms and then busts, and it just seems to go around in a cycle.
We don't do recessions here, Pete.
Well, I guess in Australia's, through the mining boom years. Yeah, they do still happen. I think we've managed to smooth the cycle quite a lot through the mining boom years and beyond. I think if you look at the price to income ratio, now this is an interesting one because people used to say years ago the price to income ratio should be a certain amount. So if you take the median price of a house versus the income, well, I guess Hong Kong would be literally off the charts there, about 42 times. Shenzhen would be 43 times. So a lot of these cities, like in fact, Australia wouldn't even feature in the top 50. I think Sydney's number 73 on that metric at about more or less 15 times an income for a house, which is extremely high, as you pointed out. Brisbane would be maybe in the top 150, and Melbourne about the same. But we do have relatively high incomes in Australia. That's a part of it. Tax settings are favourable. But yeah, actually, if you look at the median house price to income ratio, we get all these Demographia puts out its annual reports, but they only cover half a dozen cities, and Australia always features pretty high. I think if you look globally, like Numbeo or somebody like that would map it out. Yeah, you'd see Bangkok at 30 times. You'd see Seoul, Milan, Paris, London. They're all actually higher than Sydney, Melbourne, Brisbane would be. So even though there's definitely some mean reversion to happen, I don't think it's necessarily going to be seen in those numbers. Usually, what's really been tracking has been interest payments, it's household interest payments to income, and that ratio is maintained in a fairly tight range over time, and that's going to see some pressure over the next year because, as you said, the cash rate's now gone from 0 to 4.35 in a very short space of time. A lot of investors are selling down. Now, I think we may be at the crest of the interest rate cycle or pretty close to it. That might just start to ease a little bit over the next couple of years, but yeah, there's still some pain there to be had. But yeah, I think sometimes I see a lot of these we've all seen the sort of doom and gloom predictions over the past 15 years or so with people predicting, huge drops in prices, and they've never really happened. And at the moment, I guess Australia is grappling with extremely high population growth into the capital cities and just very little capacity to build at the moment. So it's an interesting debate. I mean, I often hear this sort of emotive debates. The market should be cheaper. Renting should be better, and we wouldn't necessarily disagree with that. But I guess
it's a bit like shaking your fist at the sky, though, right? Market's going to do what the market's going to do.
It is a bit. I mean, I've lived in a number of different countries. I lived in a developing country for a few years. No running water, one of the poorest countries in the world, and no healthcare, no hospitals, no sanitation. So I think almost anywhere you would go in the world, there would be challenges. Australia is expensive, it's competitive, and the housing market is very difficult for new arrivals, that's for sure. But yeah, Australia definitely has some challenges, but then I think so too does everywhere.
Yeah, I mean, so what am I? Where am I going with this? There is I think any investor, any sensible, rational investor that isn't ideologically driven, I don't think anyone here is. I only invested this because that's the only thing I invest in. I think what you would do is you recognize whether you're Warren Buffett or you're me, your capital is finite and there is an opportunity cost. Now, for the longest time, you would be pretty happy with an ordinary gross yield on a property investment because we're not getting anything in the bank and not even getting anything in term deposits. So we look today, and maybe the interest rate cycle has peaked, but I don't know if again, going back to very low levels, and as you say rightly, Pete, I don't know if we want that to happen. Careful what you wish for. But right now, I can get more than 5% in a term deposit, which is close to risk-free as you're going to get as a retail investor in Australia. And depending on where you are around the country, just in my local neck of the woods, you look at gross yield. So this is before interest payments, before agents' fees, before rates, before maintenance, before real dollar, costs that are out there. You're getting maybe 2.5%, 3%. So it's like, now people are happy to do that because they think, well, it's okay because property doubles every 7 years, or whatever the meme is, right? And you want to hope that's true, because if it's not true, you're going further up the risk spectrum for a yield that is half what you can get risk-free. And you then have to get to this really deep rabbit hole, but I think a very fruitful one, regardless of what asset class you want to talk about, which is fundamentally what drives prices. It's too frustrating for me, I think, anyway. I know you're not saying this, Pete, but a lot of people say it both in shares and in property. Is like, it's always done this, therefore it always will. We're just masters of extrapolating forward. And you ask yourself, well, what drives prices higher? So I've said one already. If I look back to 2000 onwards, we saw structural decline in interest rates from relatively very high rates to very low. We saw the rise of the two-income family. So it is the normal now, and it's not a women's lib kind of thing. It started that way and it needed to start that way. Now it's just like, well, you have to. There's no choice, right? So there's the irony in all of that. So, but then again, unless you're a polygamist or you're going to send the kids down the salt mine, you can only pull that trick once. Interest rates can only go to zero once. We've had financial deregulation, in which case the banks have just really changed their view in lending criteria and the rest of it. You've seen government support and government grants come out and increasingly generous. And you've seen immigration rip and very poor planning and supply issues. So you've had this confluence of factors that have driven prices up, and I get it. And I think you can argue, besides a couple of those points there, maybe that continues. But what happens at a point, and just as an exercise in logic without getting hung up on specific numbers here, you get to a point mathematically where it just can't be sustained. So I said before, we're actually looking for a house to buy right now. And it's interesting, the area that we're looking at, above a certain price, it's empty, like no one. We're the only ones there. Below a certain price, there's 50 people out the door. So is the demand there? Like, do people want to buy houses? Yeah. Will they want to in the future? Yeah, absolutely. A beautiful country to live in. We'll always have demand here. The same when we were renting and we're looking for a rental place. Above a certain amount per week, empty, with historically critically low vacancy rates. So there's no one looking to rent. It's just beyond a certain price, there was zero people. And then below, again, the line is around the corner. And it says to you that you hit affordability constraints, where it's kind of a question of like, where does the extra income come from to propel this gain at a point where you're doubling every 7.5 or 10 years?
Yeah, well, I guess some of it is intergenerational wealth. Now, where I come from, the inheritance tax rate is 40% in London. So once you go above the threshold, which give or take, it's £500,000, the government's snatching away 40% unless you're investing in farmland or other tax dodges. In Australia, we don't have death duties punitive in the same way. So an awful lot of wealth gets passed down, rightly or wrongly. It's just the way it is. If you look at Vaucluse or Point Piper, those intergenerational wealth, it just gets passed down. And we've got the biggest transfer of wealth in Australia's history, I guess, to come as the baby boomers drop off the perch. I think, look, on the price versus value debate, you could more or less have made that argument at any time over the past 50 years. And it's always, for various reasons that you pointed out, it's always sort of not worked out that way. And I guess it goes back to the beach analogy. If you get caught in a riptide, don't try and swim against the riptide. Just go with the direction. And I guess like when I first came to Sydney, I've got a few grey hairs on my head now. Population was more or less about 3 million. Pre-Olympics, this was. I guess what's happened, not just in Australia, this has been seen in Canada, New Zealand, United Kingdom, is that when birth rates started falling and populations weren't replacing themselves, policymakers got in a panic about deflation, falling populations, and they've gone to hard extremes now. Canada's population growth 1 million per annum. Australia's running at about 650,000 per annum, which is borderline insanity at the moment. It would have to slow down next year. New Zealand is doing the same thing. UK net migration was 740,000 over the past year. It's just nuts numbers. And I don't think that people have necessarily thought through the full implications of this. I'm not sure it's that well advised, but rightly or wrongly, I've seen the long-term projections for Greater Sydney, Greater Melbourne. Touch wood, if I live as long as Charlie Munger, Sydney's population will be 10 million by the time I drop off. It's an absolute structural change. And what we've seen, the global experience is that once a city goes beyond about 5 million, everything stops working. Infrastructure fails. We're probably seeing it this week. If you're unlucky enough to live at Roselle Interchange, you're seeing this stuff just doesn't work. And this is when we've got 50% of people are still working from home, more or less. The office vacancy rates are very, very low compared to pandemic, or sorry, occupancy rates. And people will therefore start to pay up to live in the key locations close to amenities, good school zones, close to the employment hubs. So I guess that's one factor, is it intergenerational wealth, but also people feel like the Monopoly board, they just want to be in those best locations in the capital cities. I think one of the stats I was interested to see last year is that the average US homeowner was 35 times wealthier than the average renter. And I thought, well, look, these are always, tortured statistics, and you don't want to get caught up in that kind of bullshit type of argument. But I thought I would look at some of the equivalent stats for Australia. So over the past 2 decades, the average wealth of the top 20% has grown at 4 times the rate of the lowest. That's the ABS stats. The wealthiest 20% got an average net worth of over 3 million, and the wealthiest 5% an average net worth of around 7 million, holding a third of the country's wealth. Now, what the ABS figures show is that most of Australia's wealth is tied up in real estate, rightly or wrongly. And contrary to that sort of popular image of the mum and dad investor, well, it's a bit like the old 80-20 rule. The top 20% wealthiest Australians hold over 80% of their wealth in property. 80% of the value of investment property is held by that top 20%. So I don't know if this is cause or effect. Are they wealthy because of the investment in property, or are they becoming wealthy and putting it into property? You can make the case both ways, but it's clearly a place that the money gets parked, and it's been proven politically very difficult to tackle that.
Yeah. So a couple of points in regard to that. I agree that there will be a wealth transfer. I would say Alan Kohler argued this recently, so did Noel Whittaker. The wealth transfers happened, so people were buying homes for 4 times single incomes, in my parents' generation, and now it's 13 times in Sydney at the moment. So the asset is the asset, the desire is the desire. It is unchanged, but collectively we have decided that I will work and my partner will work for 30 years, even with much, much lower interest rates, granted. But in terms of what I will put it into hours worked rather than dollars, because values of dollars change, I will work significantly more. And that's okay. That's the bargain that we've made. But again, I just push that forward, and I don't know how to share screen, so I put it on my background. That's Amsterdam. That's about 500 years of property records in Amsterdam. And the thing to note here is that it kind of fluctuated sideways right up until the year 2000, and then it just shot to the moon. And this is still a few years old, this chart, but it's still continued to go up. Now, is there a natural ceiling to all of that, or can it go forever? The old saying is, do trees grow to the sky? And even the mightiest of redwood will hit a cap at some stage. So while acknowledging all the things that you say, there is something that is, I think, inherently unsustainable. We can argue as to when that point is. Maybe it's another 10 years away. Maybe we're looking at house prices to income ratios of 50 before it gets there. But mathematically, it gets there. And the bet that I have at the moment is, in the old days, it was like, well, really the only thing I cared about is that my value of my asset was more or less maintained in real terms, and I generated an income along the way. And I get a really great income because people would pay me rent every week. It was awesome. Now I don't have an income return, especially on a real basis, on a net basis when I factor in my cost. In fact, something like 40% of investors are negatively geared. They're intentionally losing money. Like, okay, so we've crossed that threshold. So it's sort of like the only way to make money is with capital gains. And the only way that is going to continue is if we see these rubber bands be pulled tighter. And they can. I'm not saying that this is it. They'll never go higher than this. They can be. But each year that goes by where that is stretched, it just gets harder and harder. And you now have a proposition which is, it will work out well as long as collectively we as a society elect to and can afford to pay more. Now, if your mum and dad have a bunch of money and they die and you inherit some money, it's like, okay, that's nice if you have that. A lot of people don't have that. So you have all these negative externalities and consequences as a result of that as well. But again, as Alan Kohler made the point recently, it's a fake wealth. It doesn't exist. I mean, spend your money. If you live in a house and you think it's worth $1 gazillion, well, great. You can't spend it without downsizing or compromising on size or location. So it's sort of like yes, there's a wealth that is there, but the wealth has been captured by those people who got in at 4 times income, now selling at 14. That's the wealth that's been created for them, transferring the working capacity of current generations to that generation. Now, some of that generation will get it when their parents eventually die, but it's a big distortion, and it's just something that I would be cautious to bet on. You could imagine if we were having a chat about Bitcoin. I said it's up 160% this year, therefore it's going to go up 160% every year. I know you're not saying this, Pete. People do though, right? And it's like, well, really? That's the basis of it? And I feel for a lot of people in property, it is never goes down, doubles every 7 years, and it lacks an awareness of history, mathematics, and reality. And it may continue to work, but it is a game of chicken that I think whenever you're, certainly I advocate this a lot with investing in shares, is absolutely formulate a bull case. You need to have a good investment thesis here. But part of that is also factoring in the downside. So we can make the case for property, and there's cases to be made. I'm not denying that. But I think it is borderline delusional if, and I know I'm not pointing that to you, Pete, but for a lot of people to suspect that there is only upside and downside. And I feel for a lot of people, it's like, oh, if it's a bad outcome is they only make 3 or 4% real terms after. You're not thinking that actually prices do go down. Look at Spain, look at Ireland, look at America, look at a lot of, forget the real basket cases that we could point to, but a lot of developed democratic society, we have seen very, very significant and sustained falls that usually happen after a period of excessive exuberance and free money. And again, that's not to point to any timing constraints, but it feels as though every year we see these incredible gains, the next year of gains becomes a little bit more difficult. And I feel as though the asymmetry there is, okay, everything kicks down the road and we go, okay, maybe I continue to make my 7, 8, 9% gross each year, or it doesn't. And, if I've got a 10% deposit, $1 million house drops to 900,000 or drops to 950,000, I've just wiped out 50% of my capital, right? Like there is not to say that will happen, but just be aware that can happen and has happened a lot in history. And I feel as though in Australia, we're a little bit naive when thinking, but we're different somehow. And that's never sat comfortably with me.
Yeah. I mean, this is a good-natured debate, but you're actually making a very important point there. And trust me, as somebody who's British, I've seen this firsthand. People going into the housing market 100% geared, 2005, 2006, property seminars. I remember my business partner walked out of a property seminar that did pretty much follow the tagline you were saying there, or the property market doubles every decade, and it was almost being harassed by the presenter, like, this man does not want to be rich. Like it definitely can feel like a one-way bet at that part of the cycle. So and yes, you're right, March 2009 we had bank runs in the UK. It's hard to imagine a property sentiment that would be much lower than that. I guess just like in the stock market, the ebbs and flows of the cycle are also what create the opportunities.
Yes.
But you do need to be aware that the downturns can and do come. And we've actually seen them in Australia, but they've not really been quite so dramatic, usually in the capital cities. I've seen plenty of people lose money buying off the plan. Usually new apartments in Melbourne or Brisbane. I think sometimes they find that 5 or 10 years down the track, when the property is no longer new, it's lost that newness premium, and then they lose some money. I think on the liquidity point, you must be old enough to remember the equity mate adverts. So there's definitely ways in which, if you know what you're doing, you can realize some of the equity from a real estate investment. I guess in a lot of ways, it is actually a unique asset class. It's got that unique triumvirate of lending conditions. So you generally borrow at low rates. You can get high LVRs, so there's more leverage. But I guess the other thing is you can borrow very long mortgage terms with no margin calls. So there's no other asset class that's quite like it. I mean, obviously, I'm being put here to put the property side of the argument, but I would actually say, in good faith, don't put all of your eggs in one basket, because as you rightly pointed out, if you're betting your whole financial future on a specific outcome, it doesn't happen, well, you'd have some regret if you went down that route. I'm not anti-shares or anti-equities. I'm an investor in ETFs and index funds these days. So yeah, I think it's a very valid point. I guess though, real estate in many ways, as you said, I probably wouldn't bother with property if I had a $50 million inheritance coming my way, but alas, that's not going to happen. I think part of the appeal of property, for a lot of people, it's basically buy and hold, maybe do a renovation or some development, but there's not really that much thinking to be done once you're invested. There's far less analysis. You're not having to weigh up different companies and the opportunity cost. It's a somewhat imperfect market. I think it's easier to beat the average in property largely because most homeowners don't even try to. So if you're a borderless investor, I mean, even if you just followed this approach, buy the cheapest capital city, you would find that over the cycle you'll do better than average. So in 2015 that would have been Hobart, 2020 that would be Adelaide. Last couple of years it's been Perth. So there's ways that you can do better than sort of those average return. You've got a bit more control. You can add money through renovation and development, that kind of thing, although that comes with a bit of a cost of its own in terms of your energy and time. But yeah, look, I think if I was put on the spot, I would say, look, the path of least regret for people like me, and probably quite a lot of people listening, would be to have some exposure to property, whether that's through your home, maybe in a rental, but you would definitely not want to have all of the eggs in that basket. A very common strategy in Australia is actually growing some equity through real estate and then later rotating into the stock market more, sometimes using a line of credit, obviously with the usual disclaimers applying, but very often just tilting towards passive income because, of course, Australia's stock market is almost tailor-made for people wanting that passive income in retirement with the high dividend yields and the franking credits, dividend imputation. So look, I would say that, look, this is a brief summary. Most people aren't going to do better than average in shares. Probably a lot of the people on this webinar will, but most people probably won't. A lot of people would do worse. I think in real estate, even some fairly average intelligence people have done very, very well simply by buying, holding for the long term. And also there's a bit of a path of least regret here as well. I think got a lot of friends who are stock market investors who rent and have rented over a very long period of time, mid-40s now. And some of them are actually pretty pissed off that they didn't just buy somewhere at some point along their journey. So
that's this guy here.
I didn't mean you, Andrew, but
it's exactly, you summed it up perfectly. I've
been in and out of the rental market at various times because I've lived overseas, and it's good from a flexibility point of view. It can suck when you have to deal with idiot real estate agents and landlords. So there's two sides to that equation. Before I flick back to you, I should just say, if anyone's got questions, we'll probably have 15 minutes for Q&A at the end. So drop them into the Q&A box and we'll cover as many as I can. So Andrew, I'll flick it back to you. I don't want to talk all the way through.
No, they're all really good points. I mean, this is the thing. I think when you have a intelligent, balanced conversation with it, you realize that there's far more similarities than differences. And so just to harp on them for a moment, whether it's an emu farm or an investment property or a basket of shares, I think some things are always true. You want to make sure you're buying a good quality asset, not something off the plan that's been built very shoddily and you might not get for a long time versus, a house that's 50 years old with brilliant bones in a great suburb. Like, that's both property, but very, very different, right? So you want that. I think also, we touched on price as well. I think value is super important, and there will be opportunities where you get great value and there'll be other opportunities where it's sort of like less attractive. But I think one of the things that is certainly worth emphasizing is that the first rule of, quoting Munger again a lot here today, but he says the first rule of compounding is never interrupt it. And you never want to be a situation, whatever your investments are, where you're a forced seller. And so it may be true that over the next 50 years, when we look back in the year 2073, we can say, you know what, over that period, property's done pretty well. It's compounded at average at, let's call it 7% per year, pre-tax, pre-cost, sort of gross kind of things. Like, okay, that is not a disastrous outcome, except for the person who went to the eyeballs, couldn't, had a rough trot with their employment, couldn't meet their repayments, and were forced to sell into a bear market, and then were just wiped out, and they never were able to rebuild that deposit again. So whatever you're doing, surviving is the most important thing. And this is certainly true in shares, right? Like there are old generals, there are bold generals, but there are no old, bold generals, right? And it's the same in property investing and with shares. So I have the most pessimism when I meet property investors who on paper might have a very large number of properties, but when you realize the equity component is a tiny sliver and they are one blip away from being forced sold out of all of that kind of stuff. And just that leverage is a two-way street. It's a double-edged sword. And so whatever property you prefer, whatever asset class you prefer, just make sure that you allow for that. Inevitable. Property will go down at some point. I don't know when or by how, but it will happen. And if you're structured in such a way that 10% wipes you out, you want to probably have a look in the mirror. And that same goes for shares as well. So I really want to emphasize that point. Hey, Pete, we got a question. Let me read it out for you. What do you think of REITs instead of actual property investment? I'm not aware of how they have performed here in Australia over the long term. I know the leverage portion is taken out when one buys REITs, but possibly the risk can also be managed better. What are your thoughts?
Yeah, no, it's a good question. I think if you look over a 10-year period, now I haven't got numbers in front of me, all the disclaimers, but and of course there's a broad range of REITs as well. But actually, REITs have performed pretty well over that period. Now, I suppose depending on what you invest in, when there's a downturn such as we saw in the global financial crisis, there can be some serious issues with liquidity, because it goes back to the point that Andrew made before, is that real estate is not such a liquid asset class. And actually what we've seen just over the past 2 or 3 years is that incomes have gone down for a number of REITs, largely because a lot more people, probably a lot of people tuning in today, are working from home instead of working in the office. And it's, look, you can argue the toss, because I think a lot of fund managers have not fully written down the values of some of their office space, but incomes have come down. That's for sure. That's kind of in black and white. So, like, yeah, look, the returns have been very good, I guess, over a decade, very solid. You generally would not be using the same amount of leverage, but I can tell you one thing, it's a lot less of a pain in the ass than being a landlord. So it's very easy. You can buy an ETF, you can sell it tomorrow. You don't have any of the stresses and strains of dealing with tenants yourself. So I think for people who want to get exposure to real estate, there's property ETFs. I think the one caveat there is you just want to be clear what you're investing in. I think, some of the big diversified ETFs that have got good exposure across the commercial asset clusters to some of the big developers, for example, well, that's fine. I think there's some more niche ETFs that sometimes struggle with liquidity issues, and you don't want to be the bag holder there. But yeah, I think it's definitely a low stress way to get some exposure. Andrew, anything to add on that?
No, I agree with all of that. And I definitely will double down on the idea that, like, people in the industry love to just basket and bundle things together. So, you can have REITs, there's 2 REITs, but they couldn't be more different from one another, so I would likewise, I'd be very cautious, and I'm pretty nervous about a lot of commercial sort of property at this point in time. I think there's a lot of losses that have yet to be recognized on the income statement, and they're carrying assets at certain values because they're not actually valued that often until you sell it. So it's really up to the guess of a valuer to come in and say, I think it's worth this much. And history would suggest that they tend to be a little bit optimistic, and they tend to be slow to react to the realities of the market. And again, the very real reality of, if ever you are in a dire situation and you are forced selling, you cannot command the kind of premium that you otherwise would. I was around in the GFC, and I can tell you that was brutal for a lot in that sector. And what undid them? Low quality assets with excessive leverage. So by all means, go REITs. But Pete's right. Look below the hood. What exactly is in this trust? What is the strategy? What is the leverage? I would be looking closely at that.
Yeah, makes sense. Quick one here. I've got 3 properties in Perth, holding costs of around 12K. Got a dilemma. Do I sell now or hold for a few more years? I'm going to disclaim the living daylights out of this one, because obviously I don't know anything about the situation or the properties in question. I would probably say at the moment, and this is just based on, we do a little bit of stuff in Perth, the market is incredibly tight and underbuilt. And anyone who lives in WA would know that post-mining boom, which peaked, the construction boom peaked around 2011, 2012, there was a very long period where Perth prices first went backwards and then were flat. I think this is Perth's time in the sun, probably, over the next year or two. So I can't time it exactly, but if it was me, I'd be holding and looking to sell opportunistically if you're looking to offload. Here's a slightly more involved question, Andrew. Given the current interest rate environment, if one has mortgage with equity and offset and redraw, how are you thinking about total return hurdle rate to use the accessible leverage for either equity investing or considering a new investment property? Is the hurdle rate achievable over the next 5 to 10 years? It's a good question. I think, I guess the thing is, like, for a lot of people, and it all depends on personal circumstances. If you're a PAYG income earner, so you're earning, let's say, whatever your income is 100K, but then the government's taking away its slice, and then you've got, okay, what are you going to do with your post-tax dollars? Now, I guess a lot of people now are paying, and it depends, whether it's an investment property interest-only loan, but let's say for the sake of argument, the mortgage rate might be around 6%. So you're effectively saving money at that kind of rate with your post-tax dollars. Now, the question is, can you do better than that in another investment, either in property or in stocks? Now, I guess historically, if you went back to the 1950s through to today, the S&P 500 has done better than that in nominal terms. So I guess that's one way of looking at it. But there's a different aspect here as well. Valuations is one point that Andrew pointed out. But also there's the risk. I guess this is the thing. If you need to have a buffer available in a redraw account, and that's lowering your risk, it goes back to Modigliani and Miller. Like, it's not just about the return you're getting, but what risk are you taking? So it depends on your circumstances to a large degree. But Andrew, I guess you would say you'd be hoping to achieve a return of more than, let's say, 6% or thereabouts. And that might be one way in which to frame it.
I mean, that's the academic answer, right? Whenever you have a setup where the return is going to be greater than the cost of capital, the answer is yeah, do it. But in the real world, the trouble with that is that your return, well, you can only estimate your return. You know what the cost is going to be. Well, even then, right, maybe the cost changes as interest rates change as well. So if I'm doing my sums and I feel as though I can get an extra 1 or 2% by keeping my leverage high, and there's no right or wrong here. It's a personal thing. For me, I'm not putting myself and my family at that much risk for a couple of extra points of outperformance on top of that. I wouldn't. I think a lot of the time too, we forget the very real return that you get by paying off your mortgage. So let's say you're paying $1,000 a week. I don't know, just to keep the numbers round. And then imagine what your life would look like without that expense. No pay rise, nothing different. You just don't have the mortgage payment anymore. That is a very real and tangible return that you have. Plus, I would argue, one that gives you a hell of a lot of optionality, right? Like, it's not as if you have to make this decision now. So if I had a lot of equity in my home, yeah, I'd probably draw some down and invest it in shares. I probably would, because it diversifies and I get to have the benefits of leverage without the margin call and all the nonsense that goes with shares. I think it's a really smart move. If, as Charlie and Warren have been opining on, but if I was still relatively highly geared, I personally value the sleep at night factor, and just going back to my survivability element as well. So that would be what determines it for me. If I was still 70% plus LVR, I would just be focused very, very diligently on paying that debt down as much as I can, because it's a guaranteed return, and you've always got that optionality to tap onto it later.
Yeah, the guaranteed return is a good point. There's one extra wrinkle there, and that is something that got missed over the past 2 or 3 years when people had 2% fixed rate mortgages, and people say, oh, there's no point in paying down the mortgage. It's just worth reiterating. You're not just saving the 2% there, you're also saving the weighted average of whatever your future mortgage rate would be over the rest of the life of the loan. I think people are very focused on today.
Yes.
But don't forget, you might have that mortgage for 10, 20, 30 years. Don't know your situation, obviously. But also, obviously, a guaranteed return has got its own benefits. So it's one of the reasons that people enjoy, bonds or fixed interest, because they know what the return's going to be and relatively low risk. I guess there's a few other questions here. Andrew, this one's a bit, how long's a piece of string? You're a 30-year-old, you own one property outright, value 1 million, got a second property worth 1.2 million with a mortgage of 800,000. Do you sell the investment, pay down the mortgage, and diversify into a share portfolio? I guess this is very circumstantial. I think it partly goes back to, why did you invest in the property in the first place, and has that thesis changed? So I think you could certainly debate the merits of going down either path. In my experience, a lot of people have a preference for one or the other. I could see one of the other comments there. Someone saying they've been investing for 12 years, and yes, there's been some negative cash flow, but it's a no-brainer because the capital growth is more than compensated. So that's somebody who clearly prefers bricks and mortar. There's other people like yourself who just love the stock market. So I think there's probably a personal element to it. Also, well, what was the theory, or what was the point of buying the investment property in the first place, and has that circumstance changed? Otherwise, is it due to higher mortgage rates that you can't cope with? So I don't know in terms of which is the best return. Well, it's a bit like, well, how long is a piece of string? Not sure.
Yeah, I mean that's exactly the right answer. I would have given that as well. It depends on what your outlook is for that particular property and what you feel as though that can grow at. And yes, you're leveraged. So there's you got to factor that in. A very high quality property that you're very confident on, it has to fall 400K before you've wiped away your equity. It doesn't feel extremely reckless. If on the other hand, you're waking up every day, dragging yourself off to a job that you hate, and you're miserable, and you may have this sort of nominal capital value, but you're bleeding cash because the tenants need a new sink or something, how dare they want, heating or doors that lock or something like that. That's something that doesn't always fit into a spreadsheet, but I do know that is something that can weigh people down, especially when you say, as an option, as it's on the table, I could sell this thing and be free and clear. Never have I have some rates and some maintenance costs, and that's my only housing expense. And I've got $400,000 that I can invest with in other ways. If that's gonna improve the quality of life from a stress standpoint, then that is well worth considering. I say this as a finance guy. I think we all too often look too much just at the numbers, forgetting the lifestyle element. And let me put the case against shares here, right? Like most family and friends, I advise against it. Not because I don't think they could benefit from it, because I know what their personality and temperament is like. And I'm going to be getting calls all the time whenever the market dips 3% and they're freaking. And they are not going to live a comfortable, worry-free life, because they're going to be constantly stressing about every little move, and it's just not for them. So back to that into your considerations.
Yeah, fair point. Another question: super funds currently only allow you to invest in equities unless you have an SMSF. Do you think this should be extended to allow members to directly invest in real property? Personally, I don't think so. I think that's what self-managed super funds are for. I think if you want to self-manage, then you have to set up the structure and go down that route. I think logistically, for a super fund to allow people to invest in storage units or industrial sheds, I just don't know how that would work. There's often push to have to allow people to release their super and use it for, we saw this during the pandemic, right? People could release some funds, but it kind of goes against the point of having a superannuation system, I think. So I think no. Anything to add, Andrew?
I mean, they shouldn't, but they will, is my view. Like, they will.
Yeah,
I mean, and this is equal right discrimination against politicians of all stripes. There is a massive pile of money there, and it is the biggest honeypot in the country, and we already saw it in COVID. I mean, there were already people were allowed to tap into at various things. And we never let a good crisis go to waste is the saying. And at some point there'll be some kind of emergency, and people will look at that and say, listen, we can either cut back on our services, we can tax you more, or how about we just let everyone dip into their super? I suspect it's going to be something like that. I mean, did you see the other day, Pete? They were talking about JobKeeper was so successful, so we should have a HomeKeeper plan as well. It's like, yeah, it's all I'll say is it's a very, very slippery slope. So I don't think you should be allowed to, because it is there to look after you in retirement. It is not there for you to start investing in.
Yeah, as you said, it's a honeypot. It goes back to the old saying, why do people rob banks? Well, that's because that's where the money is. And it's the same with super. It's an enormous pool of funds that I'm sure the Labour government will be looking to have investing in various projects. And, whenever they need to raise tax, it's going to be a place that people look to. But that's already happening with the $3 million cap. Just one follow-up question to the redraw question. That guarantee can't be compounded over the long term if I keep money in the offset versus investing in a diversified fund. Look, with the full disclaimer here, don't know your circumstances, general advice only. This is the way I would look at it. If you've got a redraw facility and you can build up a buffer there, when Andrew mentioned, the stock market tends to be volatile. There'll be drawdowns in most calendar years. So this is the way to look at it. You can build up your buffer there, an offset or a redraw facility. And when the stock market takes a tumble, as it always does periodically, well, maybe that's when you look to deploy the capital. So you're getting that guaranteed return, but you've got some optionality there as well. Does that make sense?
Yep, it does. I mean, and it's averages are dangerous. They're very handy, but they're dangerous. So we often say in the market, that shares go up about 10% per year, dividends reinvested. And that's true. But we have had decades where it's been zero, and we've had other years where it's shot the lights out. So it is, while you can say, yes, I will get that compounding return, maybe that's true on average, but ask someone who was investing in the 70s. I mean, they had a whole decade of zero real capital growth there. And that is a potential there. So I'm not saying that will happen, but when I contrast it against the guaranteed return from the interest rate saving and peace of mind, it's just something else to consider.
Yeah, makes sense. So looks like Lee's hovering back into view. I think we're about to wind up by the looks of it.
Hey, yeah, I've just made my way back in here. It's been great conversation. We've got a couple of minutes left. I think we've gotten through most of the questions there. Any final closing comments, Andrew, Pete?
Yeah, I'll give you some closing thoughts. Whatever side of the line you're on here, just remember there are no guarantees in life, and there are no guarantees in investing. And when you have a 30-year plus sort of era to look back on and rest a certain viewpoint on, it can be very comforting, but at the same time, trees don't grow to the sky is all I would sort of say. So just have a very solid think about the investments that you're making, the risks that you're taking on to get those returns. And remember the asymmetry of the return. Again, this could be shares or property, whatever you want. So I wouldn't, as much as I'm on the share side here, I'm not saying, leverage up 10 to 1, put it all in one stock and base that entire investment thesis on what the share price has done over the last 10 years. Like that, I would not say that. And I would just I think the best investors are the ones that survive, and the ones that survive very much build their investment case on the upside, but they're hyper aware of the downside.
Yeah, it makes sense. I think it goes back to what you said. There's old traders and bold traders, but no old bold traders. You've got to be in it for the long term. I think, if you're going to do property, look, be sensible. Don't borrow more than you can afford. Take a long-term view, and I probably wouldn't watch the biannual episodes of 60 Minutes and Four Corners where every man and his dog comes out to predict the end of the world. Because if you followed some of those predictions over the past 20 years, you'd be kicking yourself. So I think that was those are probably the key points, I guess.
Brilliant. Thanks so much, Andrew, Pete, and thanks to everyone for joining us today. We hope you enjoyed this conversation. It's probably cut short in an hour. It could go, I don't know, another 1, 2, 3 days before we got closer.
Easily.
And I'm sure we'll maybe do this again next year. But yeah, thanks again, Andrew Pete. It's been a pleasure having you on, and thanks to everyone for joining us today. We hope you enjoyed it. Yeah, if you want to know more, discuss more, join us on another webinar at the ASA. Follow the guys on socials, and yeah, happy investing. Good luck to everyone.
Thanks, Lee. Thanks, everyone.
Thanks, guys.